For years, the government allowed the microfinance industry to flourish without any oversight. And now it's striking back with a vengeance. The Maligaon Committee recommendations, while welcome, are rather unrealistic. If they are accepted without any changes, smaller MFIs will have no choice but to shut shop. Well, that's great for the regulator. It's not so great for consumers. Here's why. 26.7 million people with outstanding loans of more than 18,000 crore rupees.
We first took a loan of 10,000 rupees and repaid it. Then we took another loan of 18,000 rupees and there are 3 installments left.
19 of us got together and Madam asked us what we would do with the money. We said we have to pay school fees and bear household expenses.
I would have remained a labourer all my life. Now I'm in a position to hire 4 labourers and run the business.
India's microfinance sector has come of age much faster than anyone expected, and so the dire need for a regulator. Enter the Maligaon Committee, which has stated that the Reserve Bank of India, which regulates India's banking sector, is best positioned to do the job. It has suggested legitimizing the microfinance business by having a separate category of NBFC MFIs having a minimum net worth of 15 crore rupees, a capital adequacy ratio of 15% and all net owned funds as Tier 1 capital. The committee report also says that such MFIs should have an aggregate provisions for loan losses of 1% of the outstanding loan portfolio or 50% of the aggregate loan installments overdue for 3 to 6 months, or 100% of the aggregate loan installments which are overdue for more than 6 months, whichever was higher.
If you actually look at microfinance operations of, say, 300 entities in India, and there are approximately 250 of them which are above 1.5 crore, right? Most of them have loan losses which are higher than this, right? But it's only when your portfolio goes to a certain level and you kind of work in very prime areas where the concentration of the population is high, where the income levels are good, that you can actually have loan losses which are, and provisions of them at 1%. Otherwise, typically it would be higher than that.
The committee has recommended that an NBFC MFI should have at least 90% of its total assets in the nature of qualifying assets. It has defined qualifying assets as loan given to borrowers with an annual household income of less than 50,000 rupees and capped the loan amount at 25,000 rupees. It has also recommended that 3/4 of the loan should be used only for income generating purposes. And this is the problem area.
I think this is a very tricky thing because to me, I think that, what we want to fund are ideally from our perspective, entrepreneurs who can really make a difference to their village. And the entrepreneurs who can really make a difference to the village typically may not all fall into that category. So if if someone's making 75,000 or 1 lakh a year but can employ 10 people and has that capability, why would we exclude them? Because ultimately what we're saying is, look, we don't want to be purely funding consumer purchases. We want to fund people who have entrepreneurial fire. And a lot of them are not the ones who are the poorest of the poor. Sometimes they're a little bit more better educated. They have a little more exposure so they can really make a success of a business. I think that's, so I think the income cap, I think that is something that needs to be revisited.
Apart from the income cap, there's a margin cap of 10% for MFIs that have an outstanding loan portfolio of 100 crore rupees and 12% for those that have an outstanding loan portfolio of less than 100 crore rupees. Add to that a cap of 24% on interest rates on loans, and what you have is a rather miffed microfinance sector.
The way things stand now, if you are not efficient, if your systems are not strong, the processes are not robust, the service is not good, you no longer will exist in this scheme of things. So you will not be able to provide services, you will not be able to follow the RBI guidelines or adhere to that. You can't become an efficient player, so investor will not invest, so you can't go. So it's a cycle you are into. So I think effectively what it means that smaller or inefficient players either will have to get merged or they will die a natural death, which is the harsh reality, and the efficient ones have to become much more efficient and stronger to really carry on this very life-changing work they have done till now.
So is the Malegaon committee justified in its recommendations?
The Malegaon committee is handed over, which looks so regressive, and I think this was a golden opportunity for the Reserve Bank of India to redefine what microfinance is about, and to look at how it could be included as a tool in the inclusion agenda. Some of them seem to have lost it through the Malegaon committee.
Right. What do you think is the most regressive of these proposals?
No, I think all these put together are a little bit of a problem. Interest rate cap is a problem because, smaller MFIs which are doing a whole lot of innovation do have a fair amount of higher costs. And to operate within 24%, which means that they will take a long time to break even, particularly if you're innovative. You should look at the background of all the microfinance players who came in, and they came in when the big banks were not doing this lending, and they did come out with innovative practices, and that costs. So therefore, by putting a barrier, you're basically putting a barrier on innovation.
But the fact that there is no cap on the borrowing cost of MFIs, but there's a cap on their lending rates,
that's right.
Does that create a crisis of sorts in the business model?
It does and it doesn't. In one sense, you don't get the upside of it, because when the borrowing costs are very low, there's a margin cap of 10% if you see the recommendations. So therefore, you can't even play around saying that, okay, let me play around with my borrowing sources and be efficient and keep 24% as my target pricing. Because there's also a margin cap. So therefore, when, let's say, in the current circumstances, when the BPLR or base rate, as they call it, is going up and up, their margins will be squeezed, and there's a clear upper ceiling of 24% which they can't breach. I think that's a problem there.
Right. And what about
if there was just a margin cap? I think it would have been quite okay.
3/4 of the loan for income generating purposes. Now, how is someone to really determine that? I mean, I could obviously be borrowing it, let's say, to buy a cow or a buffalo, but the fact is, I might as well use.
You can't even buy a cow or buffalo with the amount of loan that they've allowed microfinance institutions to give. 25,000 is, I think, somewhere down the line, we are totally out of sync with the reality as to how much a cow or a buffalo costs these days. A good one.
Right. So, do you think the committee has actually gone overboard in reaction to what happened in Andhra Pradesh, the ordinance and the furor that got created in Andhra Pradesh over farmer suicides, and also the usurious rates of interest that some MFIs were charging?
Unfortunately, it looks like the committee's response or the report is in response to the Andhra crisis rather than framing a national policy for microfinance, and that is where they've faltered. I think if you just look at the RBI policy that has evolved from 1998 onwards, Sridharan, you will see that RBI has been making very positive statements about microfinance all through in their credit policy as well as in the interim reviews. Their notifications are all reading very encouraging, and suddenly this is a turnaround. 1998 they set up a task force to look at regulatory and policy support for microfinance.
Right.
And even before the report was out, they had already implemented the recommendations of the report. Given that RBI had shown such alacrity, to now go back seems to be 2 steps backward.
Right. So is RBI in some sense sending out a message that it probably wants microfinance to be dominated by a few large players instead of several small players?
I don't know whether it's a message of RBI or it's a message of the Malegaon committee. I'm a little confused because Malegaon committee certainly seems to suggest that the 15 crore capitalization and therefore large players. But, if RBI was equally enthusiastic about it, they should have accepted the report in toto by now. Since they're sort of dragging their feet on it, I think there must be some rethink within RBI on whether the Malegaon committee, all these recommendations are good enough or not.
Right.
Not only that, there's a very interesting thing that has happened recently, just on, I think, 24th February, they came out with a master notification, which recapped all the notifications that they had from 1998, Master Circle and microcredit. I don't know what signal that gives, given that Malegaon committee report reads exactly opposite in its tone from all these series of notifications that they've done.
Right.
So therefore, there's a little bit of confusion as far as the outsider, but I guess RBI must be internally wondering on how to moderate this report and how to get it out.
To be fair, the Reserve Bank has done its best to protect the interests of small borrowers from the weaker section of society through this report. The committee has suggested having a Credit Information Bureau to control over-indebtedness through multiple loans and ending coercive methods of recovery used by MFIs. The committee has also stated that if its suggestions are implemented, there is no need for a separate Andhra Pradesh Microfinance Institutions Regulation of Money Lending Act.